Alrighty guys, welcome to day 4 of the FVT Trading Bootcamp. Today we're discussing everything liquidity. What is liquidity? How do I trade it? Why is it important? And we're going to start off with the basic principle, the core principle that you need to write down is that liquidity rests at swing highs and swing lows. So what I'm doing here to start off with, I'm marking out all the swing highs on this downwards move. They're in blue. The swing lows, I'm going to mark these out in red. Now, you need to write that down because the market only targets two things, guys. And this is what ICT says himself. This is one of the core or foundational principles that I use to trade. The market only targets two things. Number one, it targets liquidity. And liquidity rests at old swing highs and old swing lows. Number two, the market targets fair value gaps. And we're gonna have a complete lesson on fair value gaps a little bit later on. So as we view the market, as we look at the market, we can see whether the market is trending up or whether the market is trading down. We form swing highs and swing lows. Just like we talked about in previous videos, the market can trend up like this, the market can trend down like this, and the market can range. When the market is trending down, we'll start with that. And again, this is on a 15-minute chart. So when the market is trending down, just like here in this price section here, we form lower swing highs and lower swing lows. So what you can see, if I mark them out, you can see we've got a swing high here, swing high, swing high, swing high, swing high. Now notice in a downtrend, we are not taking out the swing highs. The swing highs are lower than one another. But what is actually happening here is notice the swing lows, right? We've got this swing low. What happens to that swing low? We're sweeping it, okay? Let's mark out the next swing low down here. What happens to this swing low? We're sweeping it. All I mean by sweeping or sweeping liquidity is taking out a point of liquidity. It's just going through, it's trading through that point. Now, what we need to understand and what you need to understand is that the market can do two things when it engages a swing high or swing low. So I'm going to illustrate this on the side here, then we'll get back into the charts. In a downtrend like this, we know that liquidity rests at the swing highs and at the swing lows. So you need to understand that principle. It's just a fundamental principle, swing highs, swing lows. Think of money resting above and money resting below. Now, in a downwards trend, what is going to happen is you are going to trade like this down. You're going to sweep a swing low, but you're not going to come back up and take out this swing high. Notice that. You're going to come down again and you're going to sweep the swing low. But notice how when we pull back, we're not pulling back up all the way up here and sweeping the high. We can, but in a really bearish trend, we're forming lower highs and lower lows, but all the swing lows are being swept. What that means is when the market is ready to turn around, when the market is ready to start doing this, right? We have a sweep of liquidity down here again, but what happens? Eventually we reverse, we form this high, and then we come up here. So we actually break structure back to the upside. And then what happens? We reverse the process. So on the way down, we're sweeping swing lows and we're forming lower swing highs. On the way up, we're sweeping the highs, and we're forming higher swing lows. And you can see that in this fractal of price here. So I'm just going to get a square around this so we can focus on this. And this is recent price structure. So I'm recording this on the 19th, and this is recent price structure. So what you're going to see is this. If we take this fractal of price like this, and let me just label it like this so you guys can see. Let's take this fractal of price, right? Let's extend this out. Now, what is price doing? Thinking of liquidity. When the market is trending down, 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 it's taking out liquidity on the sell side. It's taking out. But where is the liquidity building? The liquidity is building on the buy side. All these highs here, they hold liquidity and they haven't been raided or taken out, they haven't been swept. So there's still money resting there. That's the way to see it. At some point, you can see we have a reversal here. We have a nice reversal and we actually break above this little high, this swing high. We break above that. So that's a shift in structure. Even down here, we have a shift in structure here. And now notice when we start moving up now, what's price doing? We're sweeping the highs, but we're leaving some of the lows. And again, we've talked about this in the market structure video. The market can't keep going up or down forever. So when we're going down for a little bit, eventually we're going to reverse. And then we start going up for a little bit. And then eventually you might reverse and do something like this. There's going to be market swings that look like that. And just know that liquidity, that's the most basic principle, Liquidity rests at old swing highs and old swing lows. And in a bullish market, it's different to a bearish market. That's really, really important. Now, moving on from that, I want you guys to go to the 15-minute chart. We can zoom back anytime. Like we can go back months and months and months ago, right? We can go back here to September. And what you're going to notice is this. There are so many swing highs, so many swing lows. So you might be asking me, well, Ruben, what are the important forms of liquidity? Like what's important? Now we're going to label a few things. We're going to mark out a few things, and I'd encourage you guys to jot these down. Now, regardless of what session you trade, this type of liquidity for me is a really important form of liquidity, right? It's called low resistance. And I'm going to break this down nice and simply. There's 3 forms of low resistance, but they are all low resistance. Number 1 is what looks like accumulation. Number 2 is what I call trend line liquidity. And number 3 is relative equal highs and lows. Because what's going to happen, again, go back to that basic principle. The market is only going to target 2 things: liquidity or fair value gaps. And so we need to understand what forms of liquidity are more important and what forms don't really matter, because that's how you're going to stop getting chopped up in the market. A lot of people, they see a price swing like this on the 1-minute chart. They see a sweep of liquidity and they think that price is going to reverse. They take a short here, and what happens? It keeps going higher. The reason for that is because there's no higher time frame objective and you're not targeting the good form or the good forms of liquidity. And that is a really key point to keep in mind. So there's 3 forms and we'll get into today. So the accumulation, I want you to go to your charts and just do this. Grab a rectangle and mark out all periods of accumulation like this. Just mark them out. Any time where the market just stalls, right? Like this. And we can go a bit further in price, like this, like this. Do it on the 15-minute chart first, and then once you're happy on the 15-minute chart, then you can go down to a slightly lower time frame. And we can go back here too, look at that, all accumulation. Now, people are gonna ask me, what are my rules or what are my parameters for accumulation? Is there a specific number of handles? Is there a specific range? Am I looking for specific things? Not really, guys. Keep it simple. Accumulation is when the market is not moving in a trend up or in a trend down. I don't need it to be a certain range. I don't need it to be, oh, I can only move 20 points. I can only move 40 points. No. It's just a market structure thing that you can visually see. Whether I'm ranging like this, whether the price is ranging this big or this big, it doesn't matter. Or that big, it doesn't matter. It's still a range, it's still accumulation. So that's the first form of liquidity we want to talk about, which is the accumulation liquidity. And a lot of these things actually match up together. The second is what's called trend line liquidity. And all this is you look at price structure when it's very bunched up together, right? So when you look at liquidity, when it's really bunched up together like this, you're going to notice, if you zoom in your charts, and again, this is one of my core principles, you're going to notice that you can draw a line like this and notice how price roughly taps this quite a few times. And the same applies here. That is also trend line liquidity. The more you form, the longer you form it for. I'm going to repeat that. The more you form, the longer you form it for, the better it is. What you notice is that the market, after generating so much buy side liquidity, eventually it reverses, and when it does, it's a big move. After generating so much buy side liquidity, eventually it reverses and it's a big move. And this is really good for trending markets because we've talked about already. Even if the market's trending up, it has to pull back. And as it pulls back, it forms liquidity. And then you expect an impulsive move to that low resistance. But that's what's called trend line liquidity. And it's all the same thing. Accumulation, trend line liquidity, they're all low resistance liquidity points. And what does that mean? It means that the market should move extremely quick to those points. Even here, look, right? We've got a period of accumulation. The market drops down. Period of accumulation, the market drops down. We've got trend line liquidity here on the sell side, the market drops down. The same thing here, like trending up versus trending down. You're going to see these patterns, and go back in your charts, back test this, go on FX replay, back test this. You're going to see the same patterns. Some people call this bull flags and bear flags. That's completely fine. It is what it is, right? You can see what the market does. Even though here we're trending up, what's it doing? Right, the market is trending up, but it's also pulling back. It's pulling back. Then it stops. Then it comes down, down, down. Notice that? And what you're looking for in a trending market, or what I'm looking for, I'm looking to take longs from here, shorts from here, shorts from here. And if it's not in my session, then I have to counter trend scalp. And that's something we'll talk about as we go through in these lessons. But you need to understand that. And then another thing is relative equal highs and relative equal lows. All right, so for example here, when you look at a market like this, you can see there's relative equal highs here, and often that's the same. It's like accumulation. We blast through that. We can go into different examples, right? This high here and this high here, relative equal highs. We blast through that. Trend line liquidity, we blast through that. Trend line liquidity, we come up, we fail to take it. It's not 100%. Even here, trend line liquidity, we take it. But it's a process that you need to have, because you need, when you're trading, guys, you need to have some kind of system that you follow. You can't just go, oh, today I'm going to do this, and then tomorrow I'm going to change it, then tomorrow I'm going to change it, and then the next day I'm going to change it. Because guess what? You're not going to build confidence in your system, in your model, if you don't have a consistent way to apply the markets. And the same thing applies, right? Look at all this. We've got all this low resistance. That's trend line liquidity. And look what the market does in the New York session. Bang, drops through. Trend line liquidity. Bang, pushes up. Trend line liquidity. Accumulation. Let me just move this. Accumulation. Bang, pushes through. Trend line liquidity, pushes through. So the more we build, if we've built multiple hours of trend line liquidity, you can even see it here, look. Accumulation. Relative equal highs. Bang. The more we build, the better it is. The more bulky and packed together it looks, the better it is. And even on a bigger time frame, we can see exactly the same thing, and on a smaller time frame too. So this is a fractal concept, and that's something that I want you guys to appreciate. This is a fractal concept. If we go on to say we'll go into like a 1 hour chart, for example, you can see trend line liquidity even here, look. That's all trend line on a bigger time frame. And what's the market do? Bang, trades through. We can go back and see this principle time and time again, even on the bigger time frame. So you need to have some kind of basis to work off. You need to have some kind of, structure, because if you don't, and you don't understand these core principles, it's going to be very hard to move forward. So that's the first thing. Now, second thing, liquidity is, well, Ruben, what are the important highs and the important lows? So that applies for any session, guys. Any session, you're looking for that. That's a good target. But you're looking for, I'm going to write this out as well, depending on what session you're trading, you're looking for previous session liquidity, previous day liquidity, and really any liquidity that is on the 15-minute chart. Right, those are important liquidity forms. Now, I highly encourage you, like I've said in previous lessons, if you have not passed an account yet and you're using an eval, practice doing this yourself, guys. Indicators may be great for you once you know how to do it, but don't get an indicator and go, yeah, cool, I've got my session highs, session lows. Mark it out yourself. Put in the reps, and then once you're profitable, or once at least you've passed an eval or done something like that, then if you want the indicator, use it to make your life easier. But this is an important aspect to consider and an important topic to talk about, because a lot of people, they get up 10 indicators on their charts. They're sending me screenshots of what they're doing. They're asking me why they're not profitable, because they haven't put in the reps. Haven't seen it for themselves. You need to see it for yourself. You need to mark it out. And I still do. I don't use any indicators at all on my chart. And I'm not against people that do, but I am slightly against people that think that an indicator is going to make them profitable, because it won't. Doesn't matter whose indicator it is. It's not going to make you profitable unless you understand why the indicator is marking out what it's marking out. So let's get into this. So to clear up a lot of discussion and maybe confusion for a lot of people, stop, and this is a key point, stop getting caught up. And I've mentioned this in my Discord. So if you're from my Discord, you'll know, right? Don't get caught up in what time Asian session starts. Who cares? Trade what you see. Don't get caught up in things that, in my opinion, do not matter. So some people, they see the Asian session starting at 6 p.m. New York time. Other people at 7 p.m. Other people at 8 p.m. I've heard ICT say 7 o'clock. So that's what I used to use. Other people say 8 o'clock. That's what they use. For me, the market opens at 6 p.m. So for me, that's the start of the Asian session. Whether you agree or disagree, it doesn't matter, because at the end of the day, I'm trading what I see. And whether the market or Asian session opens at 6, 7, 8, 9, 10, 11, 12, it doesn't impact the way I trade, because I'm still looking for liquidity. I'm still looking for, fair value gaps, inversion fair value gaps. I'm still looking for market structure. So please don't get caught up by that. The market can start whenever it wants to start. For me, typically in terms of sessions, 6 p.m. to 12 p.m. or 12 a.m. I should say is Asian session. That's a good time to trade. And I'll talk more about this later. London Open is 2 a.m. to 5 a.m. and this is all in New York time. And then at 9:30 a.m. is when New York session starts. PM session, well, the lunch hour is, for PM session, lunch hour is 12 p.m. I'd say to about 1:30. But here's the thing, I used to get so caught up in that and say, oh, I can't trade at 5 a.m. because, or 6 a.m. because ICT told me not to. You can, and I do. And I think the longer you get caught up in these things that really don't matter, the less focus you're going to put onto the important aspects of trading, which is liquidity, market structure, and time in terms of macros, not time in terms of, oh, I can't trade at 7 a.m. because someone told me I couldn't. Look at the charts yourself and look at how many examples, we'll get into it later, that actually pop up in these sessions. And that's just real talk, guys. I'm very passionate about that now because I used to be a victim to that. I used to think that, I can't trade outside of silver bullet. New York session. As you know, New York session is 10 a.m. to 11 a.m. And I said, oh, I can't trade outside of that. I can't. You can. And if you want to, and it fits your schedule, and that's all you can trade, you trade when you're available, not when someone else tells you that you should be available. Because you are your own trader, and you need to understand the concept yourself. Anyway, based on that now, let's talk about a few areas or a few things that you want to look for in terms of time-based liquidity. And we'll draw this out. So, say the market's doing this, and say that is Asian session, say that's 6 o'clock open, and that's 12, right? So that's the Asian session. One thing that we see commonly, and you want to write this down, is one thing that we see is we sweep one side of the range in London session, and then we reverse in the opposite. So for example, that can be Asian low, and we sweep Asian low, and then after doing that, we react. Does it happen all the time, guys? No. And the same could happen for the other side of the equation. Maybe the market's doing this, we sweep out Asian high, and then we reverse back down. That's something that you want to have in your arsenal. That's something that you want to have in your trading, formula or strategy or playbook. It's something that occurs maybe once, a couple times a week. It's not going to happen all the time. So please don't think that what you see online about always reversing after sweeping the lower high, it doesn't always happen, because sometimes what happens in the market, this might be Asian low, right? This might be Asian low like this, which we'll mark out. And sometimes we sweep Asian low, and guess what happens? We keep going. So it's not a 100% method, and nothing in trading is 100%. And you've really got to understand that in terms of probability. We'll talk about that later. But sometimes the market sweeps that liquidity and reverses. And again, the market can really reprice whenever it wants to do so, but we use liquidity as a basis. So any previous session low or high, that could be Asian low. And let's say you trade the London or New York session, you look for a sweep of the previous session low. So for example, if you trade the London session, you're looking for the Asian low or high to be swept and then looking for a potential reversal. If you trade the New York session, right, you're looking for the London low or London high to be swept, or the Asian high, Asian low, it doesn't matter, just the previous session low or high, and then looking for a reversal. And if you trade the New York PM session, or you can look for the AM session low or high to be swept. But what about the Asian session, you might be asking? Well, if you trade the Asian session, look for the PM session lows, the ones that have been generated in the previous session, and then look for a reversal or reaction from that point. Does that make sense? So yes, you got to understand liquidity rests at swing highs and swing lows. Yes, you got to understand those three forms of low resistance liquidity. And this is a big lesson because it's quite a big topic. It's a fundamental topic to how I trade and how anyone really trades. You got to understand that. We talked about you want to look at the previous session highs and previous session lows. We talked about equal highs, equal lows, accumulation pockets, trend line liquidity, low resistance liquidity, right? And the last thing I want to talk about is previous day lows and previous day highs. Now again, do this yourself, market it yourself. Look what the market done here, right? Look, for example, look what it did here. This is a swing low, right? We came down, we swept that swing low. Now, here is your tip. If you still made it this far, you get the extra bit of sauce. A lot of people are going to ask me, how do you know that once it takes liquidity, how do you know that it's going to reverse, or how do you know that it will just continue? Well, we're going to start by saying you don't know. You may be able to anticipate a little bit, but you don't necessarily know. Nothing is 100%. But what you can observe for is look at the reaction after taking that low. You got to ask yourself, when the market trades into that low, does the market push through and continue, or does the market push and reject? If it pushes through and continues, we're probably going to take out the next low or target the next fair value gap. And I'll repeat that. If it pushes through and continues, we're probably going to target the next liquidity point or the next fair value gap. However, if it pushes through and rejects, then we're probably going to reverse back up into the previous high and the previous low. And that is where we look for a reversal. If the market does this and goes down, we look for the next low, and maybe we can look for a pullback here to continue. And we'll get more into that as we get through these lessons. And you're going to see this again on the sell side and the buy side. Look at this. We sweep this high. Does the market continue to push through? No. So we look for a reversal. Same thing, right? If we go over here, we sweep this low. Does the market continue to push through? No, we reverse. And you're going to see this. Look, if I go to a smaller time frame, look at price, for example, we go back. Look what happens here in price. We sweep out this swing low. It's really important. We sweep liquidity. Again, liquidity is where money rests, and we reprice after doing so. Perfect. Look at that. Look at that, right? Now you're going to see this on all different types of time frames. And again, it's okay to take losses. We'll talk about that in the future. But you can see we sweep liquidity and then we reverse. Every swing high and every swing low is not a point to take a reversal. Once we have a bigger structure, so you'll see this here, look at this swing low down here, right? If we go into the 15-minute time frame, and we talked about that, right? Once we sweep a higher time frame low or higher time frame high, you can't just go, okay, well, price has come up here, it's swept this high, let's look for a sell. It's not about that. If we've already swept a higher time frame low and had an impulsive move back up, market structure should suggest, right, by these candles, that we're probably going to trade a little bit higher. And we'll talk more about dealing ranges and whatnot as time goes on. But this is a really important concept. It's a really important concept because a lot of people get caught out. The market's trending and they get caught out in the reversals. And it's okay to take losses, but not every 1 minute break of structure or 1 minute shift is important. Look for higher time frame first. Look for price to sweep higher time frame levels first, and then drop down to the 1 minute to look for your entry model. And that's going to save you a lot of pain, right? It's going to save you a lot of pain. And you're going to see this apply time and time again. So what you need to understand, the market will do two things, right? If the market forms any swing high, any swing low like this, it's either going to trend, continue to sweep the highs, but project through and trade through, or it's going to do this, and then it's going to sweep a higher or low, and it's going to reverse. How do we know, or how can we anticipate? We'll get into this in the next lesson. Well, we need to look at fair value gaps, right? We need to look at points of interest. So if there's a point of interest up here, or if there's a point of interest here, you can count, we've talked about this, you can counter trend scalp to the downside. And the way I like to approach trading is, I don't care if my trade is a counter trend scalp or if I actually catch the top or the bottom. I would prefer to catch the top or the bottom because there's more opportunity for the market to run. But the way I phrase it is this: I can make money like that. I can make money like that. I can also make money like this. So why worry about being perfect? Why worry about, oh no, the market's trending? No, don't worry about that. Worry about trading what you see, and worry about, does the market have the ability, and we'll talk about this, you need to collect data. Does the market have the ability to give me enough profit or to at least move my stop to break even. If the market has the ability to do that based on liquidity, then you take the trade, right? So rule number one, the market forms swing highs and swing lows. This would be the conclusion. Swing highs and swing lows hold liquidity. Number two, when we take liquidity, we can either continue through, which is fine, or we take liquidity and reverse. And number three, we talked about trend line liquidity, equal highs, equal lows, the low resistance liquidity being a good target. So we can trade towards liquidity, number one, or we can wait for liquidity to be swept, engage a higher time frame point of interest, and then reverse. And you see that in the market, and you need to see that repeat. So that being said, a bit of a longer lesson today. Write these things down, chat in the Discord, go join the forum there. And I'm going to see you guys in the next lesson, which I believe will be about fair value gaps. And that's a really important lesson too. Again, the market only targets two things: liquidity and imbalances in the form of fair value gaps. With that being said, guys, I'll talk very soon. All the best. Peace.